All right. Well, welcome to another edition of The Advisor's Edge, and it's super exciting. Lots of fun. This is the first full episode with Chuck Failla as the co-host. And did I get anything wrong there, Chuck?
Spot on, Chad, and really glad to be part of the team here. This is going to be a lot of fun.
Yeah, it will be a lot of fun, and we're going to do something a little bit different this time. We're gonna. It sounds funny, but I'm putting you in an odd spot right at the first. We'll get into that for a minute, but before that, I want to introduce Jamie Randazzo from LSP Planning. He is a great guy with a lot of experience in this space. Jamie, how are you? Thank you for joining us.
Oh, fantastic. Glad to be here. Chuck's first co-host. We'll see how this goes. Should be a good time, as we've chatted before. So excited to be here.
It is good. This is the first recording 2026 for us. Just this week, actually, Chuck, the year in review got shipped out. So this will be fun to get this in here. There's going to be one other one between those. It took a while to get through compliance in England on one of our recordings. Anyhow, long story short, what we're going to do today is we were asked last year if we could have a good roundtable discussion or debate. I don't know how you want to call it, but really between what's the difference between an asset manager and a holistic advisor? And this immediately brought a problem up for us because we work with a lot of holistic advisors. Jamie's been kind enough to join us. He's a holistic advisor. Chuck, you run a firm that's very holistic. And the fact of the matter is, from my perspective, that's where the best of the best are going. And I think we kind of all agree that that's our perspective here. Am I wrong?
No, I tell you what, our tagline at our firm, Sovereign, is actually planning first, period, fiduciary always. So I'm happy to try to find some saving grace for the asset management only advisor. It's going to be rough, but I will give my my darndest to make that happen.
Well, thank you for being willing to take that seat, Chuck. And then, of course, Jamie, you're going to be really focusing on the perspective from the holistic advisor, and we'll try and pros and cons. It might get a little silly. Okay. I promise,
I
Chuck.
mentioned I might be able to help Chuck because it's a struggle to kind of, pull from it. But I thought about it in case the coin toss went the other way. So between the two of us, maybe we could come up with something. But yeah, no, we'll go for it.
And I promise not to use any of the satirical conversations in any clips in there. Okay. Context is important.
Yes.
So to get context here, what I really encourage folks to do is watch the whole episode, and then you'll get hopefully kind of open our eyes, think about things in a lot of different perspectives. So let's dig in. Yeah.
Absolutely.
Framing, high level context. Here's the problem. When you say holistic versus asset manager, how in the world would you define that? So let's start there, Jamie. When you think of a holistic advisor, maybe when you're talking to a client and you say, "Hey, I'm a holistic advisor. This is how we help you." How do you define it?
Yeah, sure. So from a holistic planning perspective, when you're talking with somebody, whether it's a client or even a prospect, we break it down and say, hey, there's 5 pillars of holistic wealth management. Now, one of those is going to be asset management, because that should be part of people's plan. But even outside of asset management, we talk about financial planning. And some people even have questions on what really financial planning is. Oh, that's different than asset management. Well, yes. Well, and then we also have protection planning. And we really focus on tax management, which is another one of the pillars. And there's also legacy planning. So, really 5 pillars is what encompasses, what we would consider a holistic approach, of which asset management is one of those pillars.
Yeah, absolutely. So then if you're an asset manager, and this is, I think way back in your history, Chuck, I don't know if you started in that or
Oh yeah, for sure I did.
Yeah. Okay. All right. So pull those from the archives. From the archives and tell me, if how would you define, if you were a firm that was just really strong in that asset management, how would you explain that aspect and why is that important?
Absolutely. So, again, framing this that my firm's tagline is planning first. Let's pretend that's not the case. And this, as I was joking kind of off camera before, this is kind of reminiscent of those high school debate team things where you've got to
Yes.
take the side no matter what, right? You're either for or against. I'm clearly for holistic planning. I actually really rank on non-holistic planners pretty regularly in my content. But I draw the straw that I have to defend why kicking puppies is a good idea. So let me try my best to do this. So if I was truly a pure asset management advisor, which of course I am not, here's what I would say. You don't need planning at all, because I'm going to do such a great job beating the stock market. No matter what you do for estate planning or tax planning, it's going to be irrelevant because I'm going to crush it year after year after year. That's all I got. I don't know what else an asset manager could possibly say.
You're hired. You're hired.
I don't know what to say that. But joking aside, asset management is hugely important. Of course, you need to manage those assets. And to Jamie's point, not so much for beating the market, because I don't think anyone on this call here today is thinking they're going to beat the market consistently. But what you can do is beat taxes, right? Because that is something you can truly plan for. And if I were to say I'm doing asset management only, which I think would be a mistake, but someone's got to do it. Usually it's within the context of the overall plan. I would say this, and I think Jamie was spot on with it, which is the tax management aspect. Smart portfolio management can manage taxes better than poor portfolio management. And also, I would say standard deviation, risk, volatility is also very doable with a professional at the helm as opposed to not. So as much as it's hard for me to say asset management as a standalone works, it can't. The same way that, estate planning as a standalone, that doesn't work by itself either. I don't think any one of those 5 pillars that Jamie mentions could possibly be a standalone. But if we're going to focus on the asset management for a moment, there is good asset management and bad. I would put out there that bad asset management is we're going to beat the market every time. Good luck. I don't know anyone that could do that. But what good asset management can do, and I've seen it, and I would argue we do this at our shop, and I'm sure Jamie does at his, is to be very tax conscious, be very standard deviation conscious, and then integrate that with the financial planning. So, if you are an advisor that's just doing asset management, you're probably working in conjunction with a planner. If you're not, what I would honestly say is get ready to lose a lot of clients, because as people are becoming more and more aware of holistic planning, it's not going to fly. It's just not going to fly as a standalone.
Well, and then in addition to that, I think one of the confusions that we run into in the industry is, okay, then if you're holistic, some people would say, oh, maybe you're doing, whole life insurance, which is when we say holistic, that's not really what we mean.
Yeah.
Okay. And then we get
W.
Yeah.
so you're killing me, Jamie. All right. Yeah. But yes. Yeah. So when it comes to the definition of who's playing what role, and you had a funny little acronym for that.
PINO.
Chuck. PINO. What's that?
So planner in name only. Right.
All right.
And I know these people. You guys know these people. If you're listening to this and you're an advisor, you know what a PINO is. You may not have known the term PINO, but a PINO, planner in name only, these are the people that are in those, insurance-based broker-dealers, and they sit down and they have a great office and they put together beautiful, elegant financial plans. But like the expression, all roads lead to Rome, all those financial plans lead to whole life insurance. And right. I think that's also a mistake. Right. That's the wrong type of holistic for sure, in my humble opinion.
Yeah. So, and then this just highlights the definitions and how everybody's trying to kind of set themselves up as that expert in the area. But true holistic planner, I like those 5 pillars. There's a lot of ways we can actually frame it. But why do you think clients confuse the 2 approaches?
Well, I'll jump in and, and kind of say that, we typically start with taxes. Okay. Now, taxes, if we think about a tax plan, it's like a blueprint to a house, right? We can complete this blueprint, but we still hire people to build it. And, we usually have to maintain it, which is an ongoing thing. So as it relates to our firm and tax planning, like that's a big deal. That's a big process. It's a huge pillar, right? And people have been referred to us. Oh, you don't have a good, you need a new tax guy. This, oh, go see Jamie, and he'll sit with you. And people have come in and for that first time, that hour that they're sitting there on the couch, we're having a conversation, and we barely even look at the return. I know enough. I can look at a few pages and say, okay, hey, there's a lot of room for improvement here. And people are, what are you talking about? We're here to talk. How can we improve our taxes? Well, some of these numbers on here are being produced from the investment side, and you bring things together. And as long as the conversation is easy enough for, to say somebody's got $100,000, $1 million or 10 million or 15 million, it does not mean that they're tax sophisticated or even investment savvy. Because I'm sure, Chuck, you've spoken with people that like, wow, this person's worth a ton of money, and they might know their business, but their business only. This other stuff is foreign to them, which is why us holistic planners are there to kind of help bring it together. So as people have sat on the couch, then I'll look and they'll, hey, can I see your statement? And it's let's say it's a big, I won't use any names, big bank for they're on a lot of corners.
We all know who you're talking about. It's okay.
Yeah, they're on a lot of corners, and I said, there's some tax issues with this, and we can save taxes here. And the clients are like, well, after that first hour, they walk out saying, well, thank you. We thought we were going to get our taxes done, and we're already now starting on a blueprint or a roadmap to encompass a holistic plan that gets everything, where that advisor was just focused on what stocks, bonds, mutual funds to buy. Yeah. No conversations about taxes, nothing about the estate planning. And, to me, the tax thing is an opportunity to educate on how people's investments play a role on their tax return.
Yeah.
Go ahead, Chuck.
Let me just ask Jamie a question, if I may. So, what do you guys use for your tax planning? Just go into the weeds a little bit. Are you guys like a holistic plan shop, or how do you guys go about doing the reviews?
Yeah, great question. And I love holistic plan. Yep. It is probably my number one resource, but for a lot of our clients, we also do the tax prep. So to say, hey, look, we can even utilize holistic plan along with a actual tax return. Between those two, I think we pretty much have it covered. How about you guys?
Yeah, so that's exactly what I was going to bring up. So we're definitely a holistic plan shop as well. And I think this ties in really well, Jamie, to what you said earlier, which is the 5 pillars. And yes, I think we all agree that it's important to be a holistic planner, but it's impossible, I would argue, to be an expert on each one of those 5 pillars. So we do taxes at our shop. And the way we integrate it is the advisor will use the holistic plan to have a general discussion, but we also have EAs on staff that will do the tax prep. Because I'm telling you, I think it would be a mistake for someone to be the CFP, the insurance expert, and doing the taxes. That if you wanted a good argument,
and yes, don't forget the asset management.
Don't forget the asset management that we were doing a second ago, right? So I do think there's the best structure really is an ensemble approach, right? So you need to deliver holistic planning, but I would argue that doesn't have to be, nor could it really be from one person, right? I can't imagine one person doing the plan, then doing the in-depth insurance analysis, then doing the in-depth tax review, then preparing the taxes. Talk about, jack of all trades, master of none, but there does have to be that general contractor, right? And that's the role I see playing for the advisor, and then coordinating all the sub-disciplines, right? So a general contractor certainly understands how to wire a house better than the average person, but I certainly wouldn't want my general contractor wiring my house, right? I probably want an electrician to do that. And that's an analogy I like to use quite a bit. And Jamie, that seems like what you're doing at your shop too.
Yeah, and that's kind of how we do the development of that blueprint. Same thing. And specialists are used across the board, as you're aware of, just like with money management. We have different managers that manage after-tax dollars versus pre-tax, right? Because those are tax-sensitive investments on one side, and on another side, I mean, something that's kicking off 10% income. I don't know if I want that in a taxable account, but in my Roth IRA, where it becomes tax-free, that's easy tax planning for people who pay attention. But you talk to the blurted out, the bank guy, and they're like, "Oh, we can't. We're forbidden to give that tax advice." And
right. You run into
advice.
Yeah.
But let goodness for compliance. It helps us grow our businesses.
Yeah. Tell me, Chuck. So I want you to think of it this way: is if I'm a client and come in to see you, and I am all hot on asset management because I think that's everything that's about it. Okay, because I just want to make a S ton of money. Okay, so how would you say, Chuck? I hear you're awesome. You can manage my assets. You're going to make me twice what the market can do. Let's just say I come in with that. How would you, from an asset management perspective, so just put that hat on, how would you approach that?
Yeah. So if we're going to kind of move from the satirical from earlier to like reality, if someone comes into my office today, and I say this a lot to younger advisors, you cannot sell performance because performance is not deliverable year after year. And when I say performance, I mean double the S&P. You should be able to give, and I think this is the only way to look at performance, excellent risk-adjusted returns. So whenever we're talking about performance with our clients, at least, it's never performance. It's always performance relative to standard deviation. There's two axes that you want to look at. There's the performance axis on the vertical. There's the risk axis or the standard deviation on the horizontal. And there is no such thing. So for example, let's say I delivered a 8% rate of return last year. Is that good or bad? Well, in a vacuum, it's bad, right? Because last year was a pretty good year. But if I delivered that 8% with a 3% standard deviation, that's awesome, right? Meaning you'd have a phenomenal Sharpe ratio. So it's all about educating clients. So if someone were to come into my office, but no one really does anymore because we're so clearly established as a planning firm. But if I had where we do see this, I'll take this back. We are seeing this with our KOCs, right? I love my acronyms. KOC is kid of client, right?
Okay.
Clients will come in with like, so what was your return last year? I was like, easy, Turbo. It's not all about the returns. And then it's an educational process, right? On its risk-adjusted rate of returns. But we also have multiple portfolios. We call our portfolios by name, by time horizon. We literally have a 1 to 2 year portfolio, a 3 to 5, 6 to 10, and 10 plus, right? Our 1 to 2 year portfolio is low risk, low return. Last year, it sucked if you look at it against the S&P 500, but you shouldn't be looking at it against the S&P 500. Our 10-year plus portfolio crushed it if you look against the S&P, because that's kind of our benchmark. So I really believe in educating clients, especially the ones that are coming in with that performance-only mentality. And a lot of that oftentimes is met by skepticism. Oh, well, you must not be a very good money manager. I'm like, no, we're pretty good on a risk-adjusted basis. And we could show that to you, but we got to get them out of that performance and hitting objectives. Objectives are maximizing return while minimizing risk and taxes. Kind of going back to Jamie's point earlier, those are doable things. Beating the market year after year, you might do it once or twice. And what I tell these younger advisors is be prepared to get new clients every year, because it's not going to take more than 12 to 24 months to have the client realize that you can't beat the market. Then they're going to leave and find someone else that's going to promise them to beat the market. And Chad, to your point, that was my life for about 3 years when I was a cold calling stockbroker in New York City, right? You wouldn't call saying, send over your portfolio. You're selling one stock at a time. Talking about a ridiculous way to run a business. It's like, let me sell you WR Grace. And if that works, I get a chance to sell you a second one. And if that works, I get a chance to sell you a third one. And we're still pretty damn far away from having a portfolio because we still only have 3 stocks. It's ludicrous.
Well, this is a good pivot to benefits and limitations. Okay. So obviously a limitation, if you're just doing the asset management part of it, seems to be you're really more in a transactional sort of situation with that client is kind of what I hear you saying. Am I understanding that correctly?
Without question. And it was transactional. When you're a stockbroker, it's fully transactional, right? You're only as good as that last stock that you recommended, which is just silly, right? But I mean, Jamie, I'd be curious on how you guys handle that in your shop. Especially, do you find that with your KOCs, your kids of clients? Are they coming in like, so what was your performance last year and all that type of stuff? And if so, how do you handle it?
So I've had a few of them, you know, and it's interesting. A couple of new prospects that came in, you know, they ask, because I've shifted a little bit towards online clients. So some of these people that come in, they ask for some existing clients, and the one guy called my client and said, "Hey, how are your returns last year?" Right. And my client didn't even know what to say, because I mean, they've been with me, gosh, a decade, and they're like, you know, we don't really gauge everything on a 1 year kind of performance. And they're like, you know, there's some things that they went up, but like those were our accounts that are used, you know, for 10 years plus. And, you know, the other stuff, like it didn't fluctuate nearly as much. But, you know, it's like, so I feel, you know, fortunate that, you know, from that education standpoint that you brought up, like you educate your clients. Yeah, we're not leaning 100% in a rate of return. Sure, it's important, but it is, what's the risk adjustment? When is the money needed for? So, you know, some of the younger kids, we have those same conversations. You know, hey, look, something that is super aggressive, you know, that's not the bucket we need for something that you need 8 months from now. And if that's what you're looking for, right, this is not going to be a good fit. But if you understand, and as we take people through the process, you can follow our process and our concept. Sure, there will be those accounts that can go up 20, 30, 40, 50%. But on this flip side, you know, we want to do the risk adjustment best we can, but there is obviously greater risk in that. And that's where they all say, hey, that's where we want all our money because we get the better returns. But you also know that's not also the case, right?
Yeah.
We can bring value and still get some great returns without having all the risk. And that's also why we get paid.
I love the kids of clients discussion, and I have to do kind of a best practice discussion here or bring it into the picture a little bit. Sorry, can't let go of my insurance risk hat. One of the things, because a lot of advisors, when I'm talking to them, we see claims out there from kids of clients sometimes. Okay. And you obviously, when you're working with the client, the kids of clients are there somewhere and they're in the picture, depending on the age and all of that. When it's right, though, the best practice is to pull those kids of the clients in for some level of the discussion. And I've had advisors tell me, well, I love to do that because, you know, they could be a client down the road. And I say, yes, that's great. That's fantastic. Makes complete sense. But from a risk management standpoint, even if they don't become a client, it's a good risk management conversation because you can have a conversation just like we're having right here about the value of the long term. And it's not just about asset appreciation. That's part of it. And just opening that door to them. I think, Chuck, you said it, that education. And what that's going to do is at least plant those seeds, because one of the benefits that I see of the holistic advisor is exactly the opposite challenge that you have if you're an asset manager, is that it's more relational, it's more long-term. You know, all of these things come into play. So there's a little risk tip is at some point in that relationship, you're probably going to see, hey, now might be the time to have the whole family in here. And that's going to be different for everyone, but it's a great thing. And both of you are clearly finding those opportunities, which is outstanding. Education. Okay. I'm curious, and both of you are really focused on education. I'm trying to think of if you're an asset manager only, so I'm kind of throwing this towards you, Chuck.
Yeah.
On the asset management only, what does educating a client look like? And then we'll skip it over to you,
Sure.
Jamie. But first, just from an asset management standpoint, where are you focusing?
Yeah. So it really becomes very narrowly focused to whatever product you're selling at that time, I guess. I mean, I can relate back to when I was a stockbroker, which was like from 1994 to 99 or 95 to 99. So I've got 4 years of experience of being a transactional guy. And really, there is education involved, but it really isn't a vacuum. And here's what I mean by that. If you're doing a good job, and I'm not saying people that are asset managers are doing bad jobs or doing bad for their clients, but you better be sure that there's someone else giving those other pillars of advice that Jamie mentioned before. But if we're talking purely from the asset manager's perspective, at a minimum, that asset manager's got to be able to be clear and make sure the client understands the risk return band of whatever they're selling that day, right? So, for example, if you're selling an individual stock, right, you need to have a conversation on how that's not your whole portfolio, right? This is one. And I've actually had this discussion with a very few number of clients, and I don't think any anymore. But when I first got started, as Jamie will probably attest, if someone's willing to send me their portfolio, I'll be willing to manage it, right? That certainly was my methodology 25 years ago. And a lot of times they're like, well, I'm going to give you this piece of my portfolio, but I'm going to have this one here and this one here, and they have multiple advisors. I think that's a mistake. But then what you have to tell them is, well, that's cool, as long as you know that now you are the financial planner. Right? You are the coordinator. If you're cool with that, I'm cool with that. But then make sure, as the asset manager, whatever piece that this person's giving you, define that. What is the time horizon for this piece that you've given me? What is your risk tolerance for this piece that you've given me? Are we trying to grow this? Do we have to worry about tax burdens, things like this? All the stuff that the financial planner would be doing, except now you're just doing it for this little piece here. And if I were to give one nod to the asset manager, or perhaps why it's, a viable business model, in a lot of ways it's easier, right? Because you're only worried about what's in front of you, right? And that's a bit of a callous thing to say, but if someone wants to be the financial planner, if the client wants to be the planner and like dole out pieces like there's some sort of institutional manager, good luck. But then as the asset manager, I don't care what's happening with those other portfolios. That's not my problem. I got to just make sure that I'm managing this properly within the criteria. And if you're doing that without an IPS, investment policy statement, you're making a huge mistake. Talking about risk management, Chad, I'm sure that's something that you would highly recommend for anyone, but especially if you're working on just asset management, you better have that IPS in place. If you're a holistic planner, for me, that written plan, that's my IPS, right? That shows the timeline, the cash flow needs, and that justifies the asset allocation we use, especially with our methodology, which is the bucket system, right? The 1 to 2, 3 to 5, 6 to 10, and 10 plus. So that's kind of how we handle it.
Okay, so an advantage of being an asset management only, and I'm not trying to put words in your mouth, but thinking about it here is, look, it's more transactional. I get in, I get out, I get the IPS, or I get the risk tolerance, dialed in, and I get it done and I move on.
Yeah,
right?
And I would say it's also more scalable. It is very scalable. Right. Asset management is very, very scalable because you're doing one thing all the time. When you're doing holistic planning, I mean, my conversations with 5 different clients, those are 5 very distinct, JB smiling, those are 5 different conversations. But if I'm just managing my assets, right, and we actually just recently launched a fund. So in a sense, one of the things we do at our shop is we are asset managers for that one fund. And what is nice about that one fund, I will say, is we're managing that fund. We manage it the same for anyone that's in that fund. But to your point, we need to educate whoever goes into that fund. What is this fund supposed to do? What you could expect from it and not expect from it. And that is kind of nice because that is scalable, but that's just a subcomponent of the holistic stuff we do. But if we're looking for why be an asset manager, one reason why is it's much easier to scale that than a planning practice. That's for sure.
Yeah. Well, let's kick this over to you, Jamie. When you get in there and you're educating your client, how do you approach that to make sure that they're thinking of it not only from that asset management perspective, but getting the understanding of what you're really going for?
Well, even to come back as what Chuck stated, about being an asset manager, like, and it even sounds good on some level. Like, all I have is one thing I got to focus on. And if I do it really well, right, then like others come to you for it. And, you know, and it kind of a joke, right? Because I'm never going to start doing that now because I've never done it and it's never been my thing. But it does sound awesome. You know, and I look at the relationships with other RIAs that I utilize. In like one of them in particular, they have, you know, kind of one strategy that they're awesome at. And even the guy who I work with says, like, just use that. We have another strategy, but he's like, don't even look at it because it might convince you not to use the one that you're using. You know, and that's how much he did not like it. And he's like, I don't even know why it's out there. But, you know, to come back from a, you know, and realize and say, hey, what's the education standpoint? You know, our planning process, you know, it has stages, right, that I take people through. And I'm sure, Chuck, you have a process too. And the process is what we can repeat and duplicate. In my process is built around education. So, you know, typically there's an initial phone call for a client, you know, that we have, or a prospect that is a, you know, 10 to 30 minute period where we got to make sure we even like each other if we're going to have a 10, 20, 30 year relationship, right? Because if we can't even get along for that short amount of time, you know, I have to like all of my clients? No, but there should be some give and take where in that situation, not there's any education there, but they are learning and I'm hearing what their issues are. And if I can't help them with that, and if I can't be able to say, because of the fact that you said this, this, and this, if I can't develop that after 10 to 30 minutes, you know, I don't have any right helping and educating them on why I think we should take it from, hey, I can help you do this, this, and this, to a proven education path where at the end of the process, we come to that decision together. When I put the plan in front of you, you're like, wow, this is exactly what we designed together because of the education process that incorporated some taxes, some asset management. You know, we always want to keep things at a 20,000 foot view. You know, you get to the engineer, you might be jumping in the submarine, but, you know, people fall somewhere in that range of how much they want to know, how much they already know, and if they care whether or not they know anymore. So that the trust is there. The education, I think, supports that level of trust. And like I said, sometimes a husband and wife, if one of them's an engineer, we need a one-off appointment to do a little more education. And the other one, the non-engineer, like, you know, we get it. Just let us know when we need to sign. And I think that hopefully answers that question, Chad, from an education standpoint. But, you know, I have an iPad. I have some set building blocks that we use because people typically are visual. And then usually at the end of every meeting, we'll forward that out so that people can like review what they may have just learned or heard for the first time.
Yeah. No, I love that because we love education. We know that advisors don't have to know every nitty gritty detail about their insurance coverage. They just got to know it's going to work for them and it's going to be good. And the good planners, that's what you're doing for your clients. Now, one of the challenges then becomes, well, maybe it's not a challenge. I don't do what you guys do. So you tell me. I am curious, Jamie, and then we'll kick it over to you, Chuck, for the asset management perspective.
Yep.
How do you measure success? Because this planning, the holistic planning, you got a lot of different aspects and you're okay. It's relational with the client. It's helpful. It's educational. How do you measure success when you have so many components you're working with? Okay.
So in the question, how do I measure success? That's what you kind of are asking?
Yeah. Really, it's really, so because obviously you know what it looks and feels like when you are successful with a client, right?
I mean, you'd like to think so. You know, when I measure success and I look at my top clients that have gone through our holistic planning approach, right, where we're uncovering every stone and putting this plan together, you know, and most of, you know, if we took on 10 clients this past year, they were all that type of client. And to say we measure success by the fact that 10 years from now, none of those clients are going to leave. Now, I can only go backwards in time and say, of all the clients we've done this process for, none of them have left. So as long as I guess that track record of what we have keeps moving forward, saying the process that we've developed, that we take our prospects and our clients through and develop the plan, the success is that everybody's to the point they're happy with it, that nobody leaves. And I've even had a couple of clients, that, I'll say that they've even self-admitted they're plate lickers. They can't say no to a free steak. And I just crack up. I know it's the same, couple of households, but it's awesome the multiple times we've heard that they're like, we even went in for an appointment and the advisor said they couldn't do anything better, right? They're still going for free meals though, which again is hysterical, but hey, do they feel as if we're missing something? I can't imagine at this point because it's been years. Unless somebody develops some new type of something, where we're obviously missing something as we go through people, take them through the approach. I don't really expect to lose these people unless maybe a kid gets into the industry. Those are kind of, one-offs. And Chuck, maybe you've hit that where, a kid or a nephew, cousin, somebody is in, all of a sudden you're like, wow, you really want to do that. You're moving from decades of experience to somebody new because their mentor said, call everybody on your family tree because that's what you're supposed to do. But I don't, to say, Chuck, how you measure success differently. I'd obviously love to hear it. Just to say, hey, if I can incorporate another statistic or a way to measure, and we do reach out to clients. We do have, annual events for our client appreciation. We're always still trying to bring new solutions. And typically we'll see the new solutions, right, with private equity, things of that nature. And we educate first, we do lunch and learns. But I'll stop talking at that point, pass it over Chuck and say, when you're meeting your clients.
Yeah. So it's longevity is what I'm hearing. And I like that. Chuck, how do you guys measure success as a planner firm? And then we'll talk a little bit about asset management.
Sure. So let me answer my true voice first as a planner. Then I'll try to channel what I think an asset manager would say. And I think the asset manager's answer is going to be quite simple. But for us, here's how we look at it. So success for us as a firm, I think is going to be the same exact as Jamie's, right? If the client's with us for a long time, we feel we've done our job. But how do we show success to clients? That's a little bit more tricky, I think, for a financial planner. And for that, we really lean heavily on our 5-year cash flow report. So at our shop, we're e-money super ninjas. Like we love e-money. James, do you guys, I know your Holistic Plan. We use Holistic Plan and e-money. Do you use a financial planning software as well?
We've been using Right Capital, but I think we're going to be migrating to e-money.
Yeah. Well, I tell you what, Right Capital, e-money, they're like kissing cousins. They're very similar, and they both have that 5-year cash flow report that I'm referring to. So the beauty of the 5-year cash flow report is simply this. And e-money has it, Right Capital has it, Orion Planning has it, Naviplan has it. Those are all cash flow based financial planning systems. All of them have kind of a very similar looking 5-year cash flow report. Who doesn't have that is Money Guide Pro, and that could be a whole nother discussion on why we don't use that methodology. But we do use the cash flow. So to answer your question, all of our clients that are following our core methodology, which is planning first, fiduciary always, will have a 5-year cash flow report. And in that, we could see each year how much money is coming in, how much money is going out, and then we solve for how much should be saved or spent. Meaning, most people that are working, hopefully, they're bringing in more income than they're spending, which means they should be net savers. Most people in retirement, and that's why you save for retirement, usually if you're in retirement, you're going to be spending more than's coming in from Social Security, and if you're lucky enough to have a pension. So let's look at the saver first. And I think this is a great way to keep clients accountable. So we're going to project how much do you think you're going to earn, how much do you think you're going to spend, and guess what? That's going to solve for your savings target for 2026, 2027, 2028. And here's how it works. We know what we projected for 2025. You were supposed to save $37,000. how much did you save? You saved 37, you're on track. You saved 30, you're off track. You saved 40,000, you're ahead of things. It's very quantifiable. Same thing in the drawdown cycle. Here's how much we thought you were going to bring in 2025. Here's how much we thought you're going to spend, which means this is how much we thought you were going to withdraw from your portfolios. Let's say it's $35,000 again, right? But you took out 60,000. Well, that's a problem, right? And what I call that is simply an early warning mechanism. So that way, if you overspent in 1 year, let's get our head around that now, as opposed to having a little bit of overspending each year. Then 10 years from now, you rerun that plan and like, it's a whole different plan. So I think in financial planning, it really comes down to that. If you're doing cash flow-based planning, if you're doing cash flow-based planning, I should say, you should know how much they should be saving each year while they're accumulating. And you should also know how much they should be withdrawing as they're drawing down. Then you could easily tell your clients, are you on track or if you're not? Do we want to get into a little compare and contrast on cash flow based versus goals based, which is like what you got, Pro?
We've talked a little bit about that before. I think when we first had you on the show, which is great. I mean, it's all good stuff. What's fascinating to me, and this is why you're just confirming why I'm so glad you're here, Chuck, because it helps maybe a few folks listening to this guys. Oh, it triggers some thoughts of maybe how they can either confirms that they're doing a great job, or they trigger thoughts, ooh, if I did this or that, it might generate some ideas that are truly helpful for advisors, which is really why we do the Advisor's Edge podcast. So that's fantastic. I do want you to take a little bit of point and put your asset manager hat on and see what you can think of there.
Yeah, it's simple. If an asset manager, right? And as I think about it, we actually are asset managers too. We launched a fund. So how would I say that fund should be viewed? Well, if it's meeting its objectives, what are the objectives? So what our fund is, it's actually a fund of funds of alternatives. So basically we have a one-ticket solution where you get Apollo, Blackstone, Carlyle, Monroe, Blue Owl. One ticket gets you private credit, private equity, private infrastructure, private real estate, and hedges. One ticket solution. We are really big on educating for that too. So I guess we are asset managers. It's new to us, but I guess technically we are. We see it as part of the mosaic, which is our planning, but that is an asset management function for sure. Here's how we would define success or failure. What we're looking for with this particular product is easy access to alternatives. The reason why we want access to alternatives is not because we think they're going to outperform the public markets, but because it's an additional diversifier away from public markets. Because we really it's a fact, public markets are getting incredibly concentrated, right? The S&P 500, 40% is in 7 different stocks. So it's really the S&P 7 plus, right? It's not really 500.
Some garbage. Yeah.
Exactly. Yes. So what we're looking for is, and this might surprise you, Chad, but we have an acronym for this.
An acronym. Yeah, I'm shocked.
Acronyms wrong with anything.
Let's hear this one. See if it makes any sense.
Right. So we call it HARC. So HARC in our planning methodology, HARC is hedged alternative investments and RC reduced correlation. So using my ARM chart, which I do all the time on Zooms with clients, here's what we expect of this particular fund that we have. So we are asset managers in that sense. If the stock market does this, we expect the fund to do this. If the stock market does this, we expect the fund to do this. Simple as that. In other words, we're always looking for a solid fine. A solid fine. In other words, we don't expect this fund to ever do great. What? And we don't expect this fund to ever do horribly badly. It's always a solid fine. It's a hedge. So what we would expect, markets up 20 with a 12% standard deviation, and we gave 8 or 9% with a 5% standard deviation, we're like, yep, good job. Markets down 20% and we're up 4%.
Great job.
Good job.
Yeah.
That's what we're saying, right? So we basically want to compress the risk return profile of the public markets. And as long as we're always doing less bad, or even less good with lower standard deviation, we call it mission accomplished. So after all that, I guess I am an asset manager too. I don't even think of it because I think of just another tool in the toolkit. But yeah, I mean, as a standalone, and that is a standalone registered fund, that's how we look at it as an asset manager. Yeah, for sure.
Cool. Well, interesting stuff. I think we want to end. I mean, this is great because we're highlighting a lot of different aspects. Look, good advisors, if you're asset manager or holistic, however you're doing it, there is a lot of, it's important work that you're doing for clients, right? And thinking about it from a lot of different perspectives, hopefully it can make you stronger and better and more confident. That's what we're hoping to do. So thank you for playing this game with me, if you will, guys. But we want to end strong, and I think it's more fun to think about, where are we going? What are the trends happening out there? Chuck, you're talking about, you've grown to the size where I think it makes a lot of sense where you open up your own fund because you can do it from a place of confidence and strength. Makes sense. But trends, you're dialed into those because you're really listening to what's going on in the market, as are you, Jamie. But we all have a little bit different roles. I'd like to hear from both of you. What do you see that trend and why?
Yeah. Go for it, Chuck.
Sure. I'll just say it's simply Jamie and his model. I really mean that. I think in 10 years for sure, probably 5 years, you're not going to have clients going to their financial planner and their tax guy. It's not going to happen. Mm-hmm. That's going to be more and more under one roof. I know that's where we're going with this. Jamie's there as well. I think that's a huge trend. So basically taking that concept of family office down to the mass affluent, right? And that's going to be a monster trend. And for advisors that are just doing asset management, like, again, we do asset management, which I don't even think of that, but we do. But that's a component that's being managed holistically by the planners at our shop. Mm-hmm. We do tax prep. Not one of our advisors does tax prep, right? But they will say, here's some things you want to think about because of a Holista plan, bubbling it up. But here, talk to our enrolled agent for details. So ensemble, and this is not my saying this. Well, it is, I guess, but Kitsis says this all the time, right? If you look at the most profitable practices, they are ensemble. The solo practitioner, absolutely, but I guarantee that solo practitioner has people that he or she works with. They have an accountant they work with. They have an estate lawyer they work with. They have fund managers that they like. They're just coordinating it outside of their shop. But once you get to a certain size, and our shop is there, we just have all those same components that even a sole practitioner would have, but under one roof. One way is not better than the other. They're both fine. But there's still a matter of that holistic planning being delivered by or coordinated by one person or one singular entity, but then executed with the specialist. Again, think general contractor and then electrician, plumber, framer, and so on and so forth. You're going to see more and more and more of that, in my opinion. Very cool. Jamie, what's your thoughts there?
Hey, he used me as an example, so I'll 100% agree with him. But I'll even then, say on that wave, to me, it's like you can't get away from all the attention that's been going to alternatives. And to say that Chuck is ahead of that curve by launching his own fund, that gives you a little piece of all the different aspects of private equities. Like, Pat, give one on the back, Chuck. Like, that's awesome. And obviously you had a client base where you saw, like, we need this. Nobody else is bringing it to the market. And you guys are probably doing specific cases for each client. You're like, wow, a lot of these allocations are similar. We're doing this little credit, and adding it all and putting it, like you said, to one ticket. Well, now that gives me another advisor who's fully on board with how Chuck's running his practice and doing his allocation. Because, in my mind, I learned a long time ago, like an 80-20 portfolio with stocks to bonds. And well, if the bonds are 20% and they go down 25% when the stocks are down a whole bunch, like that's not really a winning portfolio. Like we're missing something there.
Yeah.
And truly the alternative piece is that when the markets are doing this, we're doing this. Market doing this, we're doing this. They're just, when you buy into private things, they don't have to report as often. They're not liquid. So people aren't buying and selling if there's a bad quarterly report. It's a great extension. So, again, going forward, the practice should involve all of the planning. And as it comes to that asset management part, what Chuck dropped on with his fund, that's where it is going. The big brokerages, I've heard, some of them have their teams now where they do have the tax guys, but I don't think they're dealing with the, I'm typically, let's say, a $1 to $5 million sandbox for people. It seems as if those people are totally neglected, as it goes to like the competition. When I see these statements, it's like, oh yeah, wow, we can. Like at first, I was excited to see some of these statements, but now I'm like, oh my gosh, we need to talk. So education, not, once they learn the whole thing of what Chuck and I are doing, there's probably not many people that are like, we're not going to choose to work with you, because if they get it, if they follow the education that's presented to them, I say I like the words no brainer. It's a no brainer to move forward with a holistic plan.
Yeah.
Amen.
Well, I've loved this conversation. I hope you guys have enjoyed it. I think we've stirred the gray matter around a little bit. And I as we're going through it, I'm thinking about a bunch of little pieces we could pull out and talk about this or that, which is just a heck of a lot of fun. When we land the plane on this one, I just want to say thank you a ton to both of you. Fast friends here. I've known both of you for several years now, and honored that you had this open conversation with us, being willing to look at it from the different perspectives. Thank you.
Well, thank you for putting this together. And Jamie, great to meet you and really share some ideas. This was a lot of fun. Yeah, no, good times. And you guys are the hosts, so I appreciate you two having me on. And any follow-up you need from me, Chad, we go back some years now. So thanks again. Incredibly gracious. Thank you, guys. We do have some exciting guests coming up. There was at least one of them that was mentioned in this one that is already getting scheduled. So we'll just leave that as a little teaser there. And for those, if you're enjoying this show, please like it on whatever platform you're looking to it. And if you leave some comments, that's cool too. We appreciate our audience and also our guests and Chuck. Jamie, thank you so much. We'll talk to you guys later. Enjoy the day. Thanks, guys. Great time. See you.